All right, today we're going to break down an investment strategy that's built specifically for the, well, let's call them unpredictable markets that we're all trying to figure out. It's called the DynaSIF Long Short Fund. And trust me, it approaches investing a little bit differently. So let's see how it works. You know, at the heart of this whole thing is a really simple but powerful idea. The old playbook for investing, it just might not be enough anymore. The entire landscape has fundamentally shifted, and that means our portfolios, the very architecture of them, have to evolve too. So what does this new landscape actually look like? Let's drill down into the specific challenges that make that old playbook feel so, well, outdated. This slide really puts a name to what a lot of us have been feeling, right? We're seeing interest rate cycles that move at lightning speed, these sudden, out-of-nowhere spikes in volatility. And here's a big one, shifting correlations. That's just a fancy way of saying that assets that used to balance each other out are now moving together. You add in all the uncertainty around inflation and these random liquidity shocks, and you've got a recipe for an environment where those traditional static portfolios can get into some serious trouble. So given all those challenges, the obvious question is, okay, so what's the alternative? And that brings us right to the strategy we're digging into today, the DynaSIF fund, which was really built from the ground up to be an answer to this new market reality. The whole philosophy here can be boiled down to three words: dynamic, agile, and adaptive. See, instead of a rigid, fixed structure, this strategy is all about flexibility. The name DynaSIF actually comes from a Greek word, dynamis, which means power and potential. The whole goal is to be nimble enough to find opportunities and manage risk, no matter which way the market winds are blowing. Okay, so let's get into the mechanics. How does a fund actually become dynamic, agile, and adaptive? Well, the answer is in its core engine, what's called a long-short strategy. Now, long-short might sound like some complicated Wall Street jargon, but the concept is actually pretty intuitive. It's all about playing both offense and defense at the same time. You aren't just betting on assets to go up, you're also strategically positioning for some to go down. I think the best way to think about this is like driving a car. The long positions on the left, that's your accelerator. These are your bets on specific stocks that you believe are going to outperform and really drive that growth. The short or hedge positions on the right, that's your braking system. They use financial tools called derivatives to help protect your capital and dial down your overall market risk, especially when things get choppy. And this quote just sums it up perfectly. It's the goal of that braking system we just talked about. By combining short positions, hedging, and of course diversification, the aim is to participate less in market downturns. It's all about protecting your capital when it really counts. Look, having an accelerator and a brake is one thing, but knowing exactly when to use each one, that's everything. So let's pop the hood and look inside the engine room to see how this fund actively manages that balance and navigates risk. The first tool in the toolkit is flexibility. As you can see from this target allocation, the fund isn't just locked into stocks. While it might have a general mix like this, say 45% equity, it can dynamically shift between equities, debt, and even commodities. So if the big macro trends are pointing towards inflation, they might dial up the exposure to commodities. It all depends on the current market outlook. This entire risk management process really rests on four interconnected pillars. It all starts with those long-short trades, which are designed to reduce your sensitivity to the market's overall mood swings. Then, you layer on diversified bets to make sure you're not overexposed to any single company or asset. Next up is active hedging, which uses tools like options, think of them almost like insurance policies, to protect against those broad market drops. And finally, it all comes together with that dynamic allocation we just talked about, constantly shifting capital based on how the market conditions are evolving. So we've covered the what and the how, but maybe the most important question of all is, who is this strategy actually for? Let's take a closer look at the kind of investor this fund is really designed to serve. First things first, and this is super important, let's be crystal clear about the risk. This fund is officially rated as a level 2 on a 5-point scale. That puts it squarely in the lower risk category. Now, that's a key piece of information because even though the strategy uses sophisticated tools, its main goal is to manage risk and lower volatility, not to crank it up. So digging a little deeper, this fund is really built for investors who are seeking long-term growth and income, but who also realize that traditional bonds or fixed income might not cut it in today's environment. It's for someone looking for a low volatility solution and, critically, someone who's comfortable with a strategy that uses derivatives, not for wild speculation, but as a core tool for hedging and managing risk. And that brings us to the final thought I want to leave you with. We started this whole thing with the idea that markets have changed. So after looking at how a modern adaptive strategy like this works, The really crucial question to ask yourself is this: is your own portfolio architecture, is it really built to navigate the complexities and the challenges of today's market?